What's going on, guys? In this video, I'm going to show you how to invest like it's 1929. Now, for those of you who don't know what happened in 1929, it was the stock market crash that ended up causing the Great Depression. And for those of you that don't know how bad the Great Depression was, you think this 15% drop that we're experiencing as I'm recording this is bad. Imagine the S&P 500. This is actually a Dow Jones, but the S&P 500 was very similar, capped out at about, you can see, around 400 and then plummeted down below 100, all the way down to probably about 50. So it lost more than 80% of its value. We jump over to the S&P 500. We topped out at about 4,800. That would mean the S&P 500 would drop down well below 1,000 or right around 1,000. And we're only at 4,100. So we could go a lot further if this ends up being like 1929 and if we're entering a recession or even worse, a depression. Now, we could go back and we could back test all day long. This right here was March 2020, the coronavirus crash, which really wasn't too bad when you really start to zoom out. And you could see right here was the crash. It was very quick, and then we recovered really quickly. This was 2008, and this was the dot-com bubble. So those were some pretty nasty crashes. If we look at those, that is going down 54%, and the dot-com bubble was pretty much around the same, around that 54%. And it took a couple of years to recover. I mean, 2008 bottomed out at around 2009, and then we didn't see all-time highs until 2013. So that right there is 4 years before we saw all-time highs, and the dot-com bubble was even worse. It bottomed out around 2002, and we really didn't see all-time highs until 2007, which was followed by another crash. So this decade and a half was really rough. From 2000, you're pretty much not seeing all-time highs until 2013. So that's 13 years. But that is nothing compared to the Great Depression. Let's scroll all the way back. We don't even have intraday candlesticks when we go this far back. This is 1929. So to make things easier, let's just turn on a line chart. This is what we're looking at. We're looking at a peak at $30 back in 1929, and then a crash all the way down to $4. Imagine going from 30 all the way down to $4. That right there, if we do a quick little chart, you're looking at an 85% crash, which is wild to think of. And what's even crazier, if you look, it took 25 years for us to see new all-time highs. So this is a catastrophic event. This is doomsday, and a lot of people are really scared of investing in the stock market in case something like this happens again. But I am here to tell you that you do not need to worry if something like this happens, especially if you are young. If you are 40 years or younger, this would suck, don't get me wrong, but this should not scare you away from the stock market. And here's why. It's not like you're piling every last cent you have into the top and then you're planning on retiring in 3 years when it could be at the very bottom. That's not your scenario if you're 40 years or younger. Maybe you're just starting out, you throw in a couple thousand, maybe 10,000. Hey, maybe even you're able to invest over $100,000, and now we start crashing and we keep going down and you're just watching all that hard-earned money go away. The solution is so simple, and I'm going to show you in a couple of seconds, so just stick with me here. But that is fine as long as you continue to dollar cost average and average down with your buys, and then on top of that, dividends are helping you along the way. This is what I mean. So if we jump over to an S&P 500 dividend reinvested price calculator, and if we look at, we're going to go from September to September 1929 to 1954. So that's 25 years. Hit calculate. you could see your return was less than 1%. So pretty much zero. In 25 years, you would have made 0%. Your annualized return was 0.01%. That's like bank rates right now. So you're making hardly anything because we just looked at this year to this year. So you're looking at 25 years of this massive drawdown. But if you invested money into it, let's say you put $10,000 in at the very top. So you put $10,000 in right here and it crashed and you just forgot about it. And you're like, I'm not going to invest in anything else. The stock market doesn't work. I can't make money in it. Well, look at this. Your dividends that are being reinvested. So even though the stock market's crashing, there's still going to be dividends. Companies will still be paying their investors. And if you calculate for your dividends that's being reinvested, over that 25 years, you made 314%. So if you had 10,000, that 10,000 would have turned into 31,000. And that comes out to an annualized return of 5.8%. Now, that's not great returns, but that's better than losing money. I mean, that's pretty good over the course of 25 years. You were able to more than triple your money. And now let's throw dollar cost average into it. So let's use this scenario. You saved up $10,000, you threw it into the market, but you threw it in right here. You're that unlucky bastard that threw it in at the very top and it started to crash. But you said, you know what? I'm just going to keep investing every single month because that's what everyone tells me to do. That is dollar cost averaging. So your monthly investment is a very affordable $250. Nothing crazy, $250. And then if we go down to calculate, then you could see right here, your final value is $375,000. Your total investment would have been $85,000 and you would have $375,000. Your annualized return was 9.3%. So even though you just threw in $10,000 at the very top, then you started to dollar cost average. Meanwhile, the market dropped for the next few years and didn't recover for another 25 years. Finally, when you're seeing new all-time highs, you have an annualized return of 9.3%. That's not bad at all. And that comes out to $375,000 from that initial $85,000 invested. So now if we fast forward to today, things are looking pretty ugly. And especially after 2020 and 2021, a lot of people would say that we are very, very overextended and we're going to continue to see these massive drops, especially with rate hikes that are coming in June, July. We're supposed to see 6 more rate hikes this year, which that will definitely drag the market down, especially if we see 75 basis points or 100 basis points. If something like that happens, yes, it's going to really hurt the market and it's just going to keep on tumbling. And this is just the S&P 500. If we were to jump over to the NASDAQ, things are going to be even worse. It's even more volatile over there. But the simple answer, especially if you're someone that's starting out, you just dollar cost average into it. Make sure dividends are reinvested, which I do have a video on how to reinvest your dividends. So make sure that's turned on in your brokerage account. And as long as your horizon is 10 or 20 years out, especially if it's 30 or 40 years out, plenty of financial advisors would tell you you don't have to worry. Just keep dollar cost averaging into an index fund like the S&P 500 and you should be okay. And again, if we just did the back test and you could see right here, you'd be okay. If I could be guaranteed over 9% over the next 25 years, I am very happy. But I want to keep that video short and sweet. Hopefully you guys learned something from it and you're not too scared about a massive correction or even a recession or depression. The best thing you do is just be prepared for everything and anything. If you guys like this video, smash that like button. And as always, I will see you in the next one.